You ever notice how some companies seem to have this invisible shield, a kind of superpower that just protects them year after year? Well, in this explainer, we're going to go on a quest to find that shield and figure out how you can spot it.
I mean, it's the multi-billion-dollar question, right? You see these companies that just seem to have an unshakable grip on their market decade after decade. How on earth do they do it while so many others just fade away? The answer, it turns out, often comes down to one really powerful concept.
And who gave us the perfect metaphor for this? None other than the legendary investor Warren Buffett. He called it an economic moat, and it's brilliant. Just like a moat protects a castle from invaders, an economic moat protects a company's profits from competitors. It's all about finding that lasting, durable advantage.
Okay, so let's really dig in and break down what this moat actually is. We're going to move past the metaphor and get into how we can actually, measure this powerful advantage.
So at its core, an economic moat is a structural advantage a business has. It's that protective barrier, and it can be built from all sorts of things. Think about incredibly strong brand recognition. Like, you just can't compete with Coca-Cola's brand overnight. Or a powerful network effect, like with social media, where the service gets more valuable the more people use it. Or even just really high switching costs that make it a total pain for you to leave, like trying to change your main bank account.
So how do we actually find one of these things? Well, on one hand, you could go with a qualitative approach, a gut feeling. But that can be really subjective, and we've all got our biases. The other way, which is way more powerful, is through quantitative analysis. Using the hard data gives us an objective, consistent method that we can even test against history to see if it actually works.
And that's exactly what we're going to do. We're not just guessing here. Research from S&P Global actually points to 3 specific financial signals that act as really reliable, data-driven clues for finding a strong economic moat.
All right, here they are, our 3 big clues. First, a sustained high return on invested capital, or ROIC. That's basically how good a company is at turning money into more money. Second, a sustained high gross margin, which is a huge signal of pricing power. And third, high market share, which shows sheer dominance. When you see a company with all 3 of these, you're probably looking at a fortress.
So let's start with ROIC. The best way to think about this is like a company's report card. It tells you exactly how effective it is at using its money to make profits. Now, in a normal, competitive market, big profits attract rivals, right? And that usually drives everyone's returns down. But a company that can keep its ROIC high, year after year, even with all that competition, that company almost certainly has a very, very wide moat.
And look at this. The data backs it up beautifully. This research from S&P Global shows a super clear trend. The companies with the highest sustained ROIC delivered way better risk-adjusted returns. In other words, they gave you more bang for your buck, risk-wise. The numbers really do speak for themselves here.
Okay, next up, gross margin. This is all about pricing power. It's a company's ability to charge a premium price for its stuff way over what it costs to make it. You can think of strong, stable gross margins as the high castle walls, letting the company defend its profits from any competitor trying to attack.
And what do you know? The pattern is just undeniable. When you look at the historical performance, it is crystal clear. The higher and more stable a company's gross margins, the better its results have been. I mean, the top group of companies here nearly doubled the risk-adjusted return of the bottom group. That's a huge difference. And that brings us to our third indicator, market share. This one's pretty straightforward, right? It's just how much of the pie a company has in its industry. Now, just being big isn't an absolute guarantee of a moat, but it is often a very, very strong sign of powerful advantages, like incredible brand loyalty or massive economies of scale.
So it probably won't surprise you that the pattern holds up for our third signal too. Historically, companies with the biggest market share have provided the best risk-adjusted returns. It just goes to show that in a lot of industries, being the biggest player in the room really, really pays off.
Okay, so enough with the theory, right? Let's bring this out of the abstract and into the real world. What do these moats actually look like? Let's go identify some of these modern-day castles.
If we look at India, for example, we can find some super clear examples of market dominance. You've got ITC with its huge share of the cigarette market, or IRCTC, which is literally the only provider for booking railway tickets. These are classic examples of moats that are built right into the structure of the market.
Hindustan Aeronautics Limited, or HALE, is just a perfect case study. It's a key player in India's defense sector, and that strategic importance gives it a moat that's reinforced by the government itself. It's almost impossible for a competitor to challenge that.
And get a load of this number, 32 times. HALE's book-to-bill ratio is 32x.
What that means is its current order book is 32 times its annual revenue. That's not just a strong position, that's an incredible signal of long-term revenue visibility, all protected by its moat. Here's another fantastic example, the Indian Energy Exchange, or IEX. It basically has a monopoly, controlling this massive 95% slice of the market for short-term electricity contracts. I mean, when you see a chart like this, that's a clear sign of a very, very wide moat. But how does IAX keep that position? It's all about the powerful network effect. See, the more electricity producers and distributors use the exchange, the more efficient and useful it becomes. This creates this amazing virtuous cycle that is incredibly difficult for any new competitor to try and break into. So, we've seen how ROIC, gross margin, and market share are each powerful clues on their own. But what happens when you combine all three? What if you could systematically find the companies with the absolute strongest moats out there?
Well, the S&P 500 Economic Moat Index does exactly that. And the process is really straightforward and totally quantitative. First, it starts with all the companies in the S&P 500. Then, it scores every single one based on our 3 moat indicators. After that, it picks the top 50 with the highest scores. And finally, it gives them all an equal weight in the index. Simple as that.
And the historical, back-tested results? They're pretty compelling. Over a whole decade, the Moat Index didn't just deliver a higher annual return, it actually did it with less volatility than the broader market. And that, for many investors, is the holy grail, higher returns with a smoother ride. That's what a superior risk-adjusted return looks like in the wild.
This chart right here really gives us the ultimate proof point, visualizing that outperformance side by side. It shows pretty clearly that a systematic strategy focused on finding these durable competitive advantages has historically beaten the broader market.
So, what's the big takeaway here? Well, identifying these economic moats gives us a really powerful framework for finding resilient, long-lasting businesses. But remember, the past is just a guide. The real challenge and the real opportunity for all of us is to look ahead and start asking, who is digging the great moats of tomorrow?